Welcome to The Explainer. You hear about it all the time, right? Startups raising millions, sometimes hundreds of millions in venture capital. But have you ever stopped to wonder where the VCs themselves actually get their money? Well, today we're going to follow the money all the way to the top.
You know, building a high-growth company is an absolute marathon. It's this intense, crazy journey, and it's all defined by one thing: a relentless race against the clock and the bank account. A journey like that, well, it needs a very special kind of fuel to even get off the ground.
So you might be thinking, why not just get a bank loan? But for most startups, that's a total non-starter. I mean, put yourself in a loan officer's shoes for a second. You've got a company with basically no track record, very few hard assets, and a future that is, let's be honest, a giant question mark. Banks just aren't built for that kind of gamble. And that brings us to the capital quest. Let's dig into why these high-growth ventures need such a unique and frankly substantial form of investment just to get their ideas off the drawing board. I mean, just think about the disk drive industry. Back in the late 70s, it was the place to be, a real hotbed for investment. But just a few years later, bam! Intense competition and super short product cycles turned it into a low-margin bloodbath. That's the kind of crazy volatility we're talking about.
So to navigate that kind of wild uncertainty, you need a totally different class of investor. You need someone who isn't scared of the risk because they're chasing absolutely massive returns. And that right there is the world of venture capital. It's the lifeblood of the whole startup ecosystem.
Okay, but wait a minute. That just pushes the question one step further, right? It's a huge misconception that VCs are just a bunch of rich people investing their own personal fortunes. The reality is, well, it's way more structured and, frankly, a whole lot bigger. So it's time to meet the money behind the money managers. We're going to trace the capital all the way back to its source, which is usually a group of large, pretty quiet, but incredibly powerful institutions. Say hello to the limited partners, or LPs. The easiest way to think of them is as the investors in the investors. They're the ones who provide what's called dry powder, these massive pools of capital that VCs then use as ammunition for their big bets on the future. And we are talking about the absolute titans of the financial world. We're talking pension funds that manage your retirement, university endowments that keep massive schools running, huge insurance companies and foundations. They all take a tiny little slice of their portfolios and put it into high-risk, high-return assets, and venture capital fits that description perfectly.
But that begs the question, right? Why don't these huge institutions just invest directly in startups and cut out the middlemen? Well, because picking winners is incredibly hard. It takes specialized expertise, deep networks, and a ton of hands-on work. That's just not what a pension fund does.
So instead of doing it themselves, they delegate. They hand over that high-risk, high-touch work to professional fund managers. And those pros? Yep, they're the venture capitalists, the VCs. Now let's get into the venture capitalist playbook. Because VCs don't just write a check and cross their fingers. No way. They are professional investors, and they have a very specific set of rules they play by to manage all that LP money. At their core, their job is to be expert talent scouts for companies. They have to sift through literally thousands of ideas to find those few promising ventures, deploy that capital strategically, and then work like crazy to help those companies succeed. In this playbook, it's all about managing insane risk while you hunt for those unicorns. Taking a board seat, syndicating deals with other VCs, it's all about protecting the investment. And why? Because they know, going in, that most of the startups in their portfolio will fail. So the few that hit have to deliver returns that are so enormous, they pay for all the losses and then some. Okay, so the VCs have the LP's money in the bank. How do they actually structure an investment to protect that cash, knowing the high chance of failure? It all comes down to the terms of the deal. First up is valuation. Basically, what's the company worth before our new money comes in? This number is absolutely crucial because it determines how much of the company the investor gets. You know, a $5 million investment on a $10 million pre-money valuation means the investor just bought a third of the company. And here's where it gets really interesting, because not all stock is created equal. You need to know about something called liquidation preference. Think of it like a VIP line for investors. It's a contractual right that says if the company gets sold, the people who put in the cash get their money back first. And this quote, wow, it just perfectly captures the raw power of that one little clause. You can have what looks like a home run, a billion-dollar sale. But if the company raised hundreds of millions, that preference stack can be so big that after the VCs get paid back, there's literally nothing left for the founders and employees who actually built the thing. Okay, let's pull the camera back. We've seen the nuts and bolts, but let's talk about the big picture. Why does this whole ecosystem of LPs and VCs even exist? Why does it matter so much?
Just look at this number, $260 billion. That's how much capital U.S. venture firms were managing back in 2004. But what's really staggering is that just a decade before that, it was only $35 billion. That kind of explosive growth just tells you how critical this model has become for funding those big, risky, world-changing ideas.
And you got to get this. This system isn't designed to fund your local pizza place. It's designed to swing for the fences, to create or completely transform entire industries. It's an incredibly selective, high-stakes game. I mean, in 2004, VCs funded only about 2,400 companies, all in the hope of finding the next global giant. And that, at the end of the day, is the fundamental bargain of venture capital. The entire system is built on taking these huge swings. It completely accepts that most will fail, because the few that succeed can be so monumental that they don't just make a profit, they can literally change the world and refuel that whole engine of innovation all over again.
And that's our explainer for today. We've followed the money all the way from these massive LPs, through the VCs, and right into the startups. It is an incredibly powerful system, but it does leave you with one final thought, doesn't it? Is this the only way to build a great, lasting company? Thanks for joining us.